Welcome to the Rose Show podcast.
Oh, hey, Joe.
Hey, thanks for having me on, and thanks for
Thank
Jay
you.
for an awesome space. A lot of great information you guys were talking about.
Awesome. Yeah, absolutely. So thank you so much for joining. So let's continue the party. So what's going on? What's going on with this market, Joe? Tell us.
Um, as you know, when I analyze the market, I try to do my best to stay very open-minded and look at a lot of technicals, fundamentals, a little bit of macro, sprinkled on top. I always like to be open-minded, as I've talked about on Spaces. I like the expression, don't focus on what you think the market should be doing. Focus on what it's actually doing. And one way to do that, even if you're not big with the technicals, is I like to look at all the major averages. And see where they are in relation to their key moving averages on the NASDAQ, S&P 500, and some of the other major indexes. And the summary or the takeaway from there is the NASDAQ, S&P, they are below their 200-day and below their 50-day moving averages. Why that's important is because those are areas of key support, both medium and longer term for the markets. So I like to think of it as a red light, green light. When we're above those averages, it's a green light that the market, for the most part, is healthy. And when we're below those key moving averages, for the most part, the market's under distribution, the institutions are selling, and it's time to get a little bit defensive. So my first takeaway when I look at the major averages, specifically the NASDAQ, S&P, I do look at the Dow, S&P Midcap 400, and the Russell 2000. But my first takeaway is the major indexes are below those key moving averages. So that's the first thing I look at. I don't know if you sort of had any questions about that, or if you want me to keep going with the next thing. It's up to you.
You can feel free. You can tell us what your favorite Metallica song is too while you're at
it. Sure, we can get into that too. I actually saw them earlier this year. They were great, and they're going on tour next year. So I'm looking forward to that.
Absolutely.
We can definitely talk some music as well. So again, I'd like to look at the average, the major indexes. They're below their 50-day, below their 200-day. The long and short there is to be defensive. And then the next thing is I like to say is 90% of what I use to judge the health of the market is the price action of growth stocks, and specifically growth stocks because that's an area of risk appetite. That tells you if the institutions are buying growth stocks, higher valuation names. It tells you the institutions are putting risk on, where if they're buying more defensive staples names like your McDonald's, Walmart's, Procter & Gamble, things that are defensive and staples, things that you need every day, that tells you if it's more of a defensive market. And what I'm looking for specifically when I screen the markets is I go through 500 to 1,000 stocks every night, mostly because I'm very passionate about this and also because I have no life. But I do go through a lot of names. I do go through a lot of names looking for technical bases, looking for strong fundamental companies with strong earnings and sales growth, building strong technical bases, seeing if they're breaking out, seeing if the institutions are putting money to work in them, seeing if they're holding their breakouts, seeing, for the most part, just plain and simple, if they're acting well. And right now, in going through my screens, I'm finding very few bases in growth stocks. The theme there is strength is being sold into, unfortunately. And the reason why is when we're in bear markets, when we're in corrective markets, downtrends, bear markets, whatever you want to call this, breakouts tend to fail. Strength tends to get sold into. And before I get into the third thing really quick, a lot of people say, well, where can I learn the technicals or to read a lot of these charts? One simple way is William O'Neill's book, How to Make Money in Stocks, fourth edition by William O'Neill. He's the founder of Investors Business Daily. How to Make Money in Stocks, fourth edition. It's an orange cover. And literally the greatest lesson you can learn in technicals costs you $14.95, less than $15. I know I sound like it's an advertisement, but my point is it's very cheap. You buy the paperback and go through the first 100 pages of that book. Study them, memorize them. As they say, history doesn't always repeat, it tends to rhyme. But they go through the last biggest winners of the last 100 years, and the technical patterns tend to repeat themselves because human behavior tends to repeat itself. People get greedy at the same time, get fearful at the same time, and stocks act good or bad at the same time. So that's a great way for beginner traders and even investors to learn about technicals. And the reason the first 2 points are happening, meaning we're below the key moving averages on the indexes and stocks are not acting well, the reason is the Fed. The Fed is raising rates. They're taking liquidity out of the system. Why? Because they want to fight inflation. So there's a reason the late great Marty Zwei came up with the expression, don't fight the Fed, when they're providing liquidity and providing an equity-friendly environment, which is what they did after the pandemic. You don't fight it and you go along for the ride. But then when earlier this year, end of December, earlier January of this year, when they took away all of that liquidity, started raising rates, reducing their balance sheet, you don't want to fight them as well. And even to this point, you don't want to fight them because they are continuing to fight inflation and take liquidity out of the system. So we just have to be patient until that this current interest rate hiking cycle ends.
Agree. I think we need, I think you've said these words, verbal confirmation of some type of pause. For me, in my opinion, I don't foresee a cut in 2023 unless something really bad happens or something, and hopefully not. But a pause, it seems to me, by looking at just the Fed Watch tool, which I like a lot. I also, looking at the CPI and everything and seeing where we're going with that. And then the tight labor market, very important issue, because with the tight labor market, we have claims that came out today. I don't want to go too much back into the macro here, but with claims even lower by, a 216 versus 222. So it's lower than expectations. So we have tight labor market, GDP to the upside. I think Powell continues 25 is what Fed Watch is looking at right now. Maybe a pause before mid next year. And then at that point, hopefully we can, start some type of, sustainable gain. That would be great, but it's been a tough year overall. There have been a select stocks that have worked. SMCI, it's like, I think I name it on every space now. I might as well keep the record going. That one has been good, and it's solid fundamentals. Like we discussed earlier in the space, though, we don't know what the, earnings are going to be like next year with if inflation comes down, revenues are upheld by inflation as well. It's not just cost of goods sold and expenses that are elevated. So at the same time, we don't know how the fundamentals are going to fare into next year. However, I am seeing quite a few companies that have increasing margins in this environment, and there are compressed margins. So some of those have maybe will emerge as leaders, new leaders in their sectors. So we have seen Enphase has done well this year, solid numbers as well. So I tend to be fundamental investor when I go more for swings or long term. We don't know what next year will bring. We got to react. We can't try to predict too much here. But it's definitely a tough market across the board for everyone. I still like biotechs, and healthcare. I think a lot of them have run a lot. So just be careful when you see them near their highs in this market. You don't want, they have you don't buy the dip, and you got to be careful buying the dip in a bear. But also, they say, let your winners run. You got to be careful on that because the market swings the other way. So you just got to be careful. Reduced position sizing has been working well for me. It just takes the risk off a little bit and helps reduce the emotions. But yeah, the biotechs, there's a handful in there. The AMLX, we talked about that before. And I still like Rhythm. There's some in there, but it's a tough market, so.
Yeah, you use the word sustain, the word sustainable rally. I think one of the main reasons for arguments or disagreements, especially on social media, is time frame, where somebody who has a shorter term time frame might be selling something because over the next few days they think it's going lower. And somebody might be buying it at the same time because over the next few years, they think it's going higher. So it's really important.
Yes.
And I encourage people, one of the biggest things that can empower you is making decisions. I encourage people to make decisions on their own And this isn't just some BS disclaimer. This is like, don't follow anybody, including me, you, anyone you're getting. Nothing wrong to read information and get ideas from people, but don't follow anyone blindly. Have your own plan, know your own time frame, know your own risk tolerance. For somebody, taking a bigger position might be too much risk. For somebody, a small position might be a lot of risk for them. So position size is very important, knowing your plan and so forth. But for me, going back to that word sustainable, and the Fed verbally announcing, if you look at the fall of 2018, the Fed was raising rates, and they kept saying verbally, we're going to raise rates, reduce our balance sheet. We dropped in the fall of 2018, and it wasn't until January 4th of 2019 that Powell verbally said, we're going to be patient on raising rates. Now, of course, it's not an apples to apples comparison, because there was 2% and lower inflation back then. But the key message there is, and even David Tepper alluded to this today, is you almost have to take them at face value, meaning they're telling you what they're doing. So they're telling you we're raising rates and taking liquidity out of the system. Back in 2018, you had to wait until they told you they were going to pause the interest rate hiking cycle. So to your point, who knows when that's going to be, but eventually the Fed will, right now Fed funds is around 4.5, their terminal rates between 5.25. So as you said, maybe we get another 50, another quarter, 2 more quarters, 3 more quarters. Who really cares? We'll just have to wait and see until they're done, maybe February, March meeting. And then they'll probably verbally announce a pause. We got to our terminal rate of 5%, roughly, depending on the data. And then we see what happens. And then maybe from there, it doesn't mean we V bottom, but we have a level to trade off of for something sustainable, meaning for people who like to hold stocks for more than 7 minutes, maybe something that you can hold on to for a few weeks, a few months, something that you can at least buy something and relax a little bit.
Exactly. I love that point about doing your own trading plan. You took the words out of my mouth. I always speak about that as well. It's very important not to follow other people. And none of these are buy recommendations. We're just talking about the market and what we see and stocks that we may have traded or may like for our style and for our trading. Always ignore the noise and just focus on yourself. And, a lot of times on FidTwit, people flash gains and they're doing this or that. And, just try to just not get swayed by that and just come up with your own risk management strategy that works for you. And time frame is critical. This has been, I would say, in my opinion, a good day trader's market. If you're a day trader, you probably had fun in this market and done well. It seems to be working well. I'm not much, I don't really day trade. So it's been challenging, with swing and longer term. But ultimately, the most important takeaway here is have your own, yourself. It's about being self-aware and know what works for you and what your style is and where your strengths are, and go with that. And that's the best way to be successful. Trading reflects life and vice versa. So it's about knowing yourself, and that's key. So, and reducing, it's not about, we're human. We can't eliminate emotions, but we can certainly reduce those emotions, and we can try to channel them in a better way and avoid impulsivity. And that's really key. Like when we chase stocks, or we get emotional that we missed something, or we get upset that we lost, try not to trade into those feelings and emotions. And this market has definitely brought out heightened emotions in most people. So just, maybe step away from the computer and just take a break. Because it's a mental thing, right? It's mental. Big part of it, like 70-80% is mental, right?
I think, if I may, this is a very important topic, especially for retail investors. Some of them are very young. Obviously, there are people who, I've been around 22 years. I've been investing, and until about this financial crisis, I didn't learn my lesson, right? So it sometimes it takes, not just somebody telling somebody, hey, look, be careful, use your own system. Sometimes you really have to probably get a little bit of a big ding to understand it. And in Twitter, I see a lot of people follow some of the folks over here with lots of followers, and there is an influence, right? There are people, uh, basically promoting stocks that has no revenue, pre-revenue, and they did well in 2020. People got carried away. Stock like UPST was trading at $400. Then, boy, I personally know so many people lost fortunes in 2021 and also 2022 with SPAC and everything. So it's really important sometimes, and I say this to people always, and I learned my lesson through going through this is, I mean, sometimes you don't have to uh, try too hard to find stock. I mean, if you look at some of the CAGR for boarding stock like UNH, 27.5%, right? And even like Apple, Microsoft, sometimes we are trying to find the next Amazon. Just buy the next, instead of trying to find the next Apple, buy the damn Apple when it's cheap, and at least you're not going to lose your sleep, right? But we continuously looking for stock like UPST, and most of the trader or investor end up losing big, right? So it's kind of important. Sometimes I see the boring investor making a lot more money than these active investors, right? If you are a trader, it's fine. Trade in and out, that's fine. But if you are really an investor, you don't have to be super active trying to find the next Amazon. You know what I mean? So that's really my advice to different retail investor. Obviously, I know Joe for a long time. I follow him, and he is very seasoned. I read this Williams book many times, right? A lot of people have read it, but the truth of the matter is, it just not get carried away with so much noise around, and don't start picking up stock that flashing, oh, it went up 30% in one day, that might be the next Amazon. You end up losing big, right? So please understand the financial everything. So that's all I want to say.
No, those are great comments you're making, and I want to reiterate. Like, I study some of the best traders and investors throughout history. I love the expression "success leaves clues." Find someone who's successful at a strategy, whether it's technical, fundamental, value, and find something that works for your personality, and then mimic it with your own flavor. Use that blueprint, but you have to mimic it with your own personality. And as I always say, if you don't have a personality, go get one and then come back and figure it out. But in all seriousness, the best traders throughout history, they understand where you are in the big picture of things. So to your point, if the Fed's accommodative and it's an equity friendly environment, meaning they're cutting rates or they're pumping liquidity into the system, you can get away with better growth stocks and higher valuations, and some of the ones that don't have as much strong earnings, like a lot of the software names and a lot of those e-commerce names that you mentioned didn't have earnings, but they were trading on revenue growth. No different than in the late 90s, a lot of the dot-coms were trading on clicks and eyeballs. So in an accommodative market, if you know and take a step back where you are in the big picture of things, the best investors know in an accommodative market, I can cheat a little bit and valuation doesn't matter and PE doesn't matter as much. But when you're in a tightening, restrictive market where literally Powell said in the Fed minutes, we don't want the markets to go higher. Every time it goes higher, his tone gets more hawkish and hawkish. To your point, that's when you either have to get defensive, raise cash, understand growth stocks won't work. And now the funds start to tighten their belt, so to speak, and they will buy the lower valuation, you're I'm not using, just example like Merck's and stuff like that, Pfizer, some of the bigger cap pharmas that have reliable earnings. They for funds that have to put money to work, they will gravitate towards your staples and the reliable earnings things. So the key takeaway, and I love the points that you make, is to understand what type of market we're in, know if it's a time for growth or a time for value.
Excellent. Thank you so much. And yes, thank you so much for Sid for coming in, just speaking, and great points you mentioned. So thankful. Anyone else would like to, have any questions or add any input to this? Because this is open for everyone. Anyone else? Okay. Well, we'll just go on then. Well, the next part we wanted to talk about was, let's see, Joe, any other points about stock? I love the mental part. See, the mental was very important. We talk about the psychology, the market psychology, and in a market like this, it's very challenging. It's difficult for all of us. But, I want to talk about, let's see, where are we going to go to next? Any other ideas?
The mental part you talk about, it's a great point about, what Sid also talked about is, yeah, there were some people who were in, whether it was Upstart or some of the Kathy Wood names that are unfortunately down 70 to 90% off of their highs. But, you have to have a sell discipline. You have to separate your ego from the markets, your ego from your trading. And you also have to understand you're not going to be right on everything. And I say this because when I first started investing and trading, in the mid to late 90s, I just assumed when you buy a stock, everything just goes up. But sometimes companies falter, sometimes their growth slows down, sometimes they go through big booms and then they bust and they're no longer around. So you have to have a sell discipline where when things turn against you based on your time frame, you have to be able to cut your losses. Because going back to what I said about studying success, when you read the Market Wizards books, which are interviews, Jack Schwager, I think has like 4 or 5 of them now, interviews with some of the top traders and investors throughout history, there is one common theme when you read them, which is the top 3 rules: cut your losses, cut your losses, cut your losses. Just like in real estate, what are the top 3 rules? Location, location, location. In trading, you will see one common theme, no matter what their time frame is, whether they're trading commodities, whether they're trading bonds, whether they're trading stocks, whatever it is, you have to be able to cut your losses. That doesn't mean you have to cut your losses on everything, but when something really starts to break down, there should be no excuse why you're holding a stock from 400 down to $10. There's just no reason. At some point, you have to say, I'm just dead wrong on this. The company is not what I thought it was, and I have to cut my losses. So if you went through that, unfortunately, this time, we all went through that, myself included, back in the .com when a lot of stocks did that. And then you learn and you just take it as a lesson to improve the next time around.
Exactly.
Yeah, very good point, Joe. Well, one of the thing, and I like your input. If you look at the broader stock market, I see there is just handful of the companies. It's I think 38 or 37 companies over $200 billion market cap, right? There is only a couple companies over $1 trillion market cap. There might be only 70 companies over $100 billion market cap after all these 10 years. And I look at that, when some stock with $2 billion revenue, it's already 100 $150 billion like Shopify and others. I was getting worried, man. I said, that is that really so? Something to think about, right? When things happen, it's really hard to grow over 100 billion, $200 billion market cap. Even the growth, they come back real quick, right? So something, something to think about. I would love to hear your input, Joe and Rosanna. This is something I look at, and it was a big red flag to me when, in late 2021.
Yeah, remember I talked about studying the O'Neill, how to make money in stocks. It's a great point that you make. I talk about selling on the downside, cutting your losses. There should be no reason why you hold a stock from 400 down to $10. At the same time, when you look at those biggest winners throughout history, at some point, if you were lucky, you mentioned Shopify, that was $30 off of its IPO base prior to I think they split 10 for 1, and it went to 1,600. I mean, I don't know how else to say this without swearing, but for F's sake, like when a stock goes from 30 to 1,600 and you don't take profits, I can't help you there. No one can help you. You're just never, ever selling. You're just married to it and you think it's going to go up forever. My point being that when you study history and you get 100, 200, 300, 500% gain, as they say, bulls make money, bears make money, pigs get slaughtered. If you're not taking at least some profits when something is up, let's say you bought Shopify at 30 or 60 or 100, and the thing's sitting at 800, 900, split adjusted 1,200. If you're just that greedy to not even on 100 shares take 25 off of the table, take your original cost off the table and let the rest run, at some point you have to be able to take profits. And to your point, understand not too many companies go up to 200 billion, 500 billion, trillion market caps. The FANGs were an exception. And those are just amazing companies with just amazing moats. But the point is that if you get a stock that goes up 2, 3, 400%, at some point you have to learn how to take profits on the upside. And then people say, well, what if I miss out? What are you missing out on? You just made 300% on the stock. What's the FOMO? Like it's going to go higher? Then sell a little bit. If it goes higher, you still have some. If it goes lower, you took some profits. So selling is a very important thing, both on the upside and on the downside when you're wrong.
I love that. If it goes from 30 to 1600, that's true. I mean, I like to scale out and I scale into positions. So, and that's how my style is. So I'd like to share that with everyone. Cutting losses is very important. You raised a great point, Joe. A lot of times people don't want to cut their losses, say they're down like 10, 15, 20%. They're worried it's going to reverse and it's going to come back. And it's like, especially in this market, though, it has not been the case. I've noticed a lot of stocks, they were down 30, 40%. Now they're down like 50, 60%. There's so many of them. We can't even begin to name them. I mean, there's like so many of them. So it's just important to keep your rules and to make sure you cut your losses when you need to. And, it's not about a certain number. I like to look at charts. I look at pivot points and I look at certain support levels. And if stocks break support levels, especially in this market, I don't care if I think it will reverse. It's just not, it's not a safe strategy to hold on to it. So it's very important to cut. Also, trading is actually supposed to be boring. I remember reading that like so many years ago, that if you start getting too excited and it gets exciting and you get very high and low, maybe it's bordering on, gambling. So it's actually supposed to be boring. I don't know who said that, but I think maybe a few great traders said that. So that's just another important thing, removing the emotion from that. But in this market, we have systemic risk. We also have business risk. We spoke about the debt earlier. Now, there's been a lot of debt that was accumulated since, for the past few years. And, there is a rise in the cost of debt and capital. So companies that have higher debt, it is concerning. I always look at free cash flow yields and, just cash flow and period, high margins. It's very important to find companies with cash, especially in this type of tightening liquidity, compressed margins, rise in the cost of debt, productivity's down, the whole thing. So, it's very important when you find companies to look for those cash flows. And then I just want to touch about one point briefly about the equity risk premium. And it's not something people talk about as often. I think it's very important as the risk-free rate is higher. Like we know treasuries right now about 4.2%. You can get over 4%, let's just say that. So when you have the risk-free rate higher, then the actual yields of equities, let's just say SPX, has to go higher. So that means that because you're going to have to get more for your money to take on that risk if you're able to get 4% at risk-free. So valuations and price come down. So when people start saying, oh, it was this price and now it's this price, it can't go much lower. Well, actually it can. And we've seen that. It's because we're in a different environment and things are like getting re-rated. It's like you can't even compare it to the type of price it was last year or even earlier this year. I mean, the Fed went from 0 to what? We're at 4.5 right now, 4.2, 4.25, something like that. Right. And so, so it's like, it's a different environment. So don't hold yourself to that price that it has to go back to that price. It's a different financial environment.
And things change. I mean, one of my favorite lines from Paul Tudor Jones is, you adapt, evolve, or die, or whatever the expression is. I'm paraphrasing it, but the key word is adapt. You have to adapt to the market environment we're in. So in a equity-friendly environment, as we talked about before, you can justify the S&P at, 18, 20, 25 times, earnings, that type of thing, especially if it's a very equity-friendly, low interest rate environment. It justifies higher higher valuations, both in the overall market and in individual stocks. But in a restrictive tightening environment, you have to say, well, you make a great point. Not only do the valuations change, but also the companies might not earn as much. So maybe the stock won't go back to that level because they're not going to earn as much. I think, Sid mentioned Shopify. I don't mean to pick on it. I'm just, it's one that he referred to. And they went from earning nothing to earning $6. And now they're going to earn 40 cents in the next year. So more competition. Amazon is a competing product, all this other stuff. The point is that things change, so you have to adapt. Like, sometimes when you say, well, why doesn't it go higher? Because earnings and sales is what mostly drives stocks higher. And if the earnings picture changes, you have to adapt to that. And even Tepper alluded to that as well this morning. David Tepper, who's brilliant and one of the best out there. You can even I retweeted his interview, but he basically said, if we go through a recession, the S&P earnings estimates of $230 next year, $230 collectively for the 500 companies to earn, that could come down to 210 or 215 or 200. And if that's the case, you have to, have a lower multiple if we're going into a more difficult environment. Even Mike Wilson from Morgan Stanley talked about that as well. So it's a great point you make, that the earnings change in both the companies and in the markets, and the multiples change depending on if we're in a equity friendly environment or in a a restrictive or a challenging environment where the Fed's taking liquidity out of the system.
I think this is also another very important learning that many of us probably don't know. When you frequently will see that example, okay, it's just 5x PS, and this and that is very cheap. Why it's going down? When the earnings slows and it becomes consecutive quarter of slows, the market cap run the reverse direction so quickly, right? That's why you will find a lot of companies, because they are not growing, but they have probably $3 billion revenue, but still $5 billion market cap, right? So and this is another thing, that the stock sometimes recycles so quickly, and very few stocks continue to make new highs, right? I remember Panera Bread at one point was a hot stock. You remember, Joe? Citrix was at one point very hot stock. F5 at one point was very good technical hot stock, right?
Yeah.
And 3-4 years they disappeared. People didn't even talk about that. Their market cap now start running on the reverse direction, right? So it's very important that long-term investor is a good idea. A lot of oil being made, but trust me, very, very, very few stocks continue to make high, right? FANG is exception. Even with FANG, Amazon, Netflix, Facebook, you know what happened, right? 5 years no return. So it's very important to be even long-term investor, but keep your eye open, right?
Yeah, you make a great point. I mean, to find the next Amazon or to actually pick the next Amazon or Apple is nearly impossible. It's not to discourage people, but it's just there's the law of large numbers, and probabilities of finding something that's just a long-term amazing winner that's just going to go up and up forever. It's so difficult to find them, because not only do you have to find them, but you have to have the conviction to stick with them. It's like all those people, oh, if you put 10,000 in Amazon off the IPO, it'd be whatever millions now. But how many people would stick through 290+% corrections? So you have to pick them, stick with them through a lot of corrections. Even when Carl Icahn made $2 billion off of Netflix, he held it for 2 years, and there were 4 separate 30 to 40% corrections, which most people can't stomach one of them, never mind 4 of them. So picking a stock that's going to go up forever is nearly impossible. That's why, like Warren Buffett, when he picks stocks that he holds on to long term, they are going to have pristine balance sheets and pay dividends. So at least if you're going to sit in something that's going to go sideways or be dead money, you're at least collecting a 2, 3, maybe even a 4% dividend. And then if you get the capital appreciation over time, then that's great. But it's just something to keep in mind. It's not to discourage people, is that everyone's like, oh, I want to find the next Amazon. It's nearly impossible to do that, because we only know after the fact how amazing a company was. Like you mentioned with Citrix and Panera Bread and all these names, some of them go through huge growth periods. Their stocks go up tremendously. Then when the growth slows, they become dead money. And that's where, you know, as we alluded to before, you just have to take some profits along the way up.
I love that point, especially like in hindsight, it always seems so much easier. So like, for example, like Enphase, a lot of people got in under $1, you know, but then it ran up and then it dropped, I think, what, 70, 80% or something. And then it's like to hold through all those drops, you know, that's a lot. And not only you have to find them, but you have to be able to hold them. And many people will call you very silly and foolish even. How could you hold the stock down 90%, you know, 2 or 3 times? It's like to actually hold it through all those times, I think that's the hardest part. Finding a good stock is easier than actually being able to hold it through all those downturns. So I think that's the hardest part, actually, for me at least, you know.
So let's say that you could hold it, right? But the 99% of them is not going to be Amazon, not going to be Apple, right? So you just holding to basically the dead money and sitting and all those things, right? So that's the tough part. Like people could hold it if 70% of them becomes Amazon and comes back, right? The truth of the matter is they don't come back, right? I think
Most of them don't. You're right.
Yeah.
No, I mean, think of the 90s, like the 95 to 2000 or even 90 to 2000. There were 4 big stocks that made huge runs. Microsoft, Dell, Cisco, and Amazon. And I know Compaq did well as well, but there was a big PC boom in the 90s where computers and personal computers became more popular and more people got laptops, blah, 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 more PCs in the home. So Dell was the major number 1 maker, along with Compaq was number 2. Microsoft put the software on the PCs, Intel put the chips on the PCs, and Cisco connected them together. So if you have an office in LA and New York, they could talk to each other. So those stocks, they IPO'd at a much lower valuation and went up 30,000 to 70,000%. Then when you look at them, well, Dell went private, but when you look at them, Intel and Cisco have been dead money for 20-something years. Microsoft was dead money for 13 to 15 years before they reinvented themselves when Satya Nadella came in, and then it made a good run. But the point is, those stocks made amazing runs. We live in such an impatient world where people can't hang on to stuff that long. I mean, you know, the only reason people are still in the Intels and Ciscos is because these companies, they don't go out of business, but they make so much cash that they decide to pay a dividend. So at least while you're sitting in something that's dead money, they're kind enough to give you, you know, some shareholder return. But to your point, it's nearly impossible to think, oh, I'm going to find something and it's going to go up forever. When you study history, those stocks like the Amazons and Apples are so few and far between.
Yeah, but do we really need to be that greedy, right? We don't have to have that. You know, if we can have some, you know, solid, nice returns, you know, there's plenty of great companies out there. You know, trying to find those special, far and few between ones is very difficult as well. So if all what we can do, we can't change other things. We can change ourselves and our decision making, and our analysis is what we have control over. So if we look at the factors, what I like to look at, you get your fundamentals. You don't have to go deep dive on them. You don't have to know all, you know, the current ratio. You don't have to go into all that. You know, EV over revenues are important. You know, I prefer that over market cap. So that's important. You know, that helps gauge companies in the same sector. You know, PE is decent. You know, with growth, you know, stocks, I tend to look at free cash flow, and, you know, there are a lot of other metrics. Just know a few. You know, look at the margins, watch the earnings reports, look at the pattern over time, and then look at the technicals. You just got to be simple. Moving averages, you know, the 50, the 200, the 21 is great. You know, and you have your options flow you can look at if you're familiar with that. You look at some sentiment, you get a little bit of the macro. It's like a recipe. You just get out little pieces of everything and you put it all together, and, you know, you see what works. And you have to come up with your own plan and what works for you. And I think that's the best we can do. And I think if you're consistent and you're flexible and you keep an open mind, you can definitely have steady returns over time. You don't have to go for that, shoot the moon one, and, a lot of people who entered the market the past 2 years have like a false sense of reality of how the market is. Now, I've been trading, and I'm not a full-time trader since 2000, but I've been trading most of the years since 2000. I'm also an entrepreneur. I run businesses, so I do other things as well. But I am an options trader, and I've been trading. So I remember 2000, and I remember 2008, and I remember all those times, and I remember the times in between. 2020, 2020 was an anomaly. It was a different type of market. It's not something that, is common. And a lot of people, unfortunately, are expecting those kind of runs, and they're expecting it still, even though we've had this rough year. They're still thinking that that's how the market should be. And that's really not a normal market. It's work. It takes work to make money. Otherwise everyone would be wealthy, So it takes work. So if you feel you're working, that's good. You should be working. We reap what we sow. We sow, we reap what we sow. That's it. And, I'm like, which way is it? But, the point is that, it doesn't come easy. So don't beat yourself up if you feel it doesn't. And, just have realistic goals, and, just keep an open mind and be flexible. But I will say, one thing I want to say, it will get better eventually. It will. It's not going to be like this forever. Just stay positive.
Yeah, I think this is, we'll look back, right? A lot of people, cry for this type of, market downturn, right? That's when the wealth is made, right? So people will look back, I'm sure. I don't know how long it's gonna be, 1 year, 2 year, 3 year, but it will bounce back, right? Uh, Probably S&P, NASDAQ will, cross their all-time high again, right? And we'll look back and say, oh, how easy it was, right? Why didn't I buy some good stock, right? One other thing that I tell to my family member friends, because they call and they ask for, because they realize that, okay, I know a little bit about it, so what stock I should buy, right? And they will come up with a name, a very interesting name. So I say that, well, when things are on sale, don't pick up the crap. I mean, pick up the good one, right? I mean, it's like if Amazon is on sale, why I'm going and picking up Wayfair, right? I mean, not to bash Wayfair, right? I rather put my money on Amazon, right? If I want to really invest on retail things. So so that's another thing, it's a great time to start looking at what you want to pick up, because this will pass. I mean, 1 year, 2 year, 3 year, eventually it passes, and you will look back and you would think what a great opportunity it was, right? So
Yeah, no, that's a great point. Well, first of all, when your family knows you know about stocks, or friends, just don't even tell them, because they'll never stop bothering you. So, like, if I'm somewhere and someone asks what I do for a living, I just say I own an ice cream shop, because I really don't want to have a 9-hour conversation about the stock market with them, because what are they going to do? Ask you like how many flavors you have? Like, I'd rather just not answer questions about stocks with random people. Anyways, I'm kidding. But you make a great point, and Rosanna mentioned this too, and I want to reiterate that. I always like to try to keep a positive message, in the sense of coming out of this, we will have a new uptrend. We will have a new bull market. And to your point, Sid, we just don't know if it's going to be a few weeks, a few months, or longer. Who knows? But you've got to put in your work, do your due diligence. For people who like to trade individual stocks, and the examples I give is coming out of 08, 09, when we had the global financial crisis, housing crisis, and all that stuff. When we eventually bottomed March, April of 09, Green Mountain Coffee and Netflix were two of the first stocks to emerge to new highs, and they went on for anywhere from 1,000 to 3,000% returns. And the point I want to make is that, number one, we will come out of this, so keep your head up and protect your confidence. And number two is, when we come out of this, there are newer entrepreneurial companies that are in amazing growth stages right now, that are just being held back by the weight of the market. And as soon as the tension's relieved off of the markets, and as soon as we can start a new uptrend, there will be amazing growth companies, like Netflix was at 5 to 10 million subscribers before they went to over 200 million subscribers. Green Mountain Coffee that made the Keurigs, they were in less than 1% of households before they went to 7 or 10% of households. So the amazing growth stories are there, and there are newer companies that will come out of this. You just have to be patient until the market shows signs of bottoming and the selling starts to stabilize. And to reiterate both of your points, there'll be great opportunities. You just have to be patient until they start to show themselves.
Exactly. Thank you. Now, Sphinx, did you want to say something?
Hi there.
Yeah.
Hi there.
Hi, welcome.
Thank you so much. Oh my God, I just love your spaces as always. Sorry, I kept dropping there. And I just wanted to say, a couple of things. First is, listening to, first of all, I'm not a trader, okay? But I do come from the world of finance. I was a private equity analyst at Goldman. So I come from the world of finance, and I'm more of an investor, right? So what I do is I research stocks and really thoroughly research them, and then I'll buy. And I'm really sort of like, I hate risk and all that stuff, but I'm into growth stocks. So anyway, point being, listening to you guys talking about cutting your losses really sort of made me want to ask this question, because it really hit home for me, as it has been for about almost a year, because in just one of my positions alone, and I don't mind sharing this information, because I think it's good to share your mistakes, right? Because there's this falsehood that everyone out there is perfect, but we're not. So
This is Twitter, man. We don't make mistakes. We only have winners here.
Okay, well,
it's a joke. It's a joke. Hashtag sarcasm. I'm kidding. Go ahead.
hashtag you had me wondering for a minute. No, I'm just
You're
kidding.
like, is this jerk for real?
I was like,
no,
what? Okay, no.
I'm kidding.
So what
Go
I
ahead.
wanted to say is, in one position alone, which is an index fund, I'm down $1 million. Okay. And at this point, I want to tell you the mistake that I made. The mistake that I made was, so it nosedived a couple weeks after Russia attacked Ukraine. I made many mistakes with that one. Thankfully, I don't have to sell, okay? But I made huge mistakes here. One thing I want to do is I want you to tell me if there's a distinction to be made with respect to the principles you guys talked about cutting your losses when it comes to trading versus a longer term investor, like many people here in the audience and myself. And I'll tell you a couple mistakes that I made that now, hindsight's 20/20, but still I'm kind of like, I don't know how many hairs I've pulled out. So it's like, the whole trading thing. A friend of mine said, the economy is about to go to shit, right? And I was like, I believe in these stocks. I have studied the stocks in this fund. I believe in these stocks. So I'm okay. And here's the thing. And I kept saying, I'm not a trader. But here's the thing. Here's what I didn't consider. I didn't think about selling part of the position and then buying it back at a lower price. I didn't consider that. And I'm just like, had this thing, well, I'm not a trader. I can't mess with that kind of thing. And so what I wanted to sort of, it was just very eye-opening for me, right? So that you don't necessarily need to be a full-time trader to be aware of some of these things. What would you say when it comes to these things you talked about that are so important? I appreciate it so much, about like cutting your losses. At this point, I'm going to tell you, I'm not going to sell, because at this point, it's practically, it can go to zero now. I mean, it went from a lot to basically nothing. So, and I don't have to sell. And I'm like, every time I'm like, Warren Buffett said, don't look at it. So I'm not even looking at it anymore. So anyway, whatever. Warren can take me to lunch. But I want to know what you're just, if you guys make a distinction between like a day trader or trader and someone who invests more for the long term, but that person still does feel these effects. Thanks for letting me ramble.
Well,
You're
really
never
quick.
rambling.
No,
you go first. I'm going to go after you.
Oh, also,
go ahead,
I
Rosanna.
love you,
Ladies
Rosanna.
first. Go ahead.
I love you too. You're awesome. Thank you so much for coming.
Thank
We
you.
love all
Thank
you
you.
guys. Joe,
No,
you go
Rosanna.
first. That's it.
No, go ahead. Ladies first. Go ahead.
Okay. Well, first of all, we all make mistakes. Okay. And I make them all the time. And I thought I would have learned by now, but I still make them. So you're not alone there. Okay. And I've been down significantly, probably more than that. So, but I come back. You eventually come back, you know, and I've come back, and the losses I made were nothing compared to what I make. So just stay positive, because it's about your mindset, never giving up, and that's important. But regarding this particular issue, I have to be honest with you, it really depends. I hate using that word, but it really depends. I'm a long-term investor. That's me. I'm number one, I'm long-term, and I'm an investor. Long-term to me though, you know, I sell, you know, sometimes 6 months, a year, because the way that time has been, it's so hard to just say I'm going to buy and hold forever. I just don't do that anymore. So when I say long term, maybe I'm using the term incorrectly with the traditional use of it. But I mean, you know, 9 months, a year, maybe even 6 months. So maybe I'm midterm, okay? But I'm basically months plus. I've held positions for years. I have some for years. So that's me. It depends on the company. It depends on the fundament. If something fundamentally changes, then to me, that's a sign that I may need to sell. So it's not about the number of the actual percentage down, but is it just the market, or is it the company itself? So I always
Purely
look
the
at
market.
Okay,
Purely the
well then
market,
that's
yeah.
okay. Well, that's a positive. That's a very strong positive, in my opinion. So if it's the market versus the company, then I would feel a lot better about it. But if it's the company itself, like we've seen with a lot of these like SPACs and all these, and I don't mean to knock on SPACs, but all these other companies that have emerged and we see other issues arising, I would be concerned. And at that point, I would be very concerned. But if it's about the market, and it's not an option, because you know options have a time element, and I am an options trader. If I do something shorter term, I do options. I'm an options trader with spreads and all kinds of options. So if it's not options have that time element, so you have to sell at some point. So that's another concern. So if you have something that is to you a solid company, that it's down because of the market, and you're already past that point, and we all know that point that you're past, that it's like, it's almost like might as well just hold it at this point, you know, like that kind of thinking. To me, and this is my personal thing, I'd probably just hold. I don't know the particulars. I don't know the company, and I don't need to know. But that's just me, and that's my own personal feeling on that. Joe, I'm sure you have a very wise and professional, great outlook perspective on this one.
So much pressure. No, the point you made, Sphinx, about you're down on an index fund. It depends if it's like, you know, index fund or sector specific ETF. But the point is that the answer, and it's never investment advice, the answer has to do whether it's an index fund or a specific stock. If it's an index fund, let's say the S&P or the Qs or something like that, they're designed over time to go up over every 10, 20, 30-year period. So I agree, if it's an index fund, stick with it, because they take the weaker stocks out and they put the stronger stocks in, and they're constantly rebalancing and adding and taking out stocks. So an index fund over time is designed to always go up, just statistically over the last whatever 100 years, over every 10, 20. You can look at the studies, those periods. But with individual stocks, that's a tricky one, because as we mentioned earlier, it's really hard to pick those stocks that just do really well over a 10, 20-year period, just because eventually the growth slows down. And as we discussed, they become dead money. So you know, Warren Buffett might be hanging on to some stuff because of the balance sheet, and Coca-Cola's never going out of business, and he collects his dividends, stuff like that. American Express, some of the ones he owns. But, you know, to pick stocks as well as he has over his career, that's something that the average person, myself included, that's where it's very difficult to do. And number two, he's 92 years old and investing for the long term, which to me is, I can't think of anything more optimistic than someone who's 92 and investing for the long term. So he has a little bit of a different, you know, philosophy and value versus growth.
Phoenix, hopefully I pronunciated your name well, Phoenix or Phoenix, but I have some boring answer for you. I don't know, it's a index fund like S&P or
I apologize. I did say index fund. It's actually a straight stock fund. It's a stock fund, yeah.
okay,
So
okay.
it's a fund with different stocks of different companies in it. It's not an index fund.
Okay, all right. That's all right. I mean, like, I'm not saying that, but Kathy Wood, right? It doesn't track any index. She has the innovation and next generation fund. So, just like Joe and Rosanna said that if it was an index fund, don't worry, you are a long-term investor, it will align, it will go up. Let's say this is not an index fund, right? You really have to see what are the holding inside, right? It's since 2008, I have never lost money in Apple, right? Because time is my friend. I mean, I buy at any price. Eventually, it goes up. Then I sell it. Right? It's a simple, simple investing. I follow that. It at one point it goes up. Right? So it goes down. I buy it. Eventually, it goes up because I have unlimited time. Right? So you really have to see what is inside that funds, right? Every single. And if you see that there are some solid companies, right? I mean, Apple generates $100 billion in just profit. Okay. And all the 401k money, all those passive money that's coming in, they all hit. Everybody buying, all index fund pretty much has it, right? So this stock is very hard to, take a big hit. Like Microsoft and Apple is everywhere, and there are so many others. So you really have to see what's inside, and then make your decisions, right? If there are companies that, like Scald, SKLZ, this company probably have gone bankrupt, but it was, FinTwit favorite at one point, right? If it's full of those companies, then I would say that, market is down now. You may have a better chance recovering, putting that money elsewhere, right? Sometimes I do that. I rotate and I put that money elsewhere, right? Tesla is down. I'm not saying you have to buy Tesla, but Tesla is down 70% right now, right? So I have a better chance to probably recover in Tesla than some company that's, not cash flow positive or losing money significantly, right? So just a thought, right? Few things, right? It's hard to know exactly without knowing what are the stocks inside.
That was a long silence right there. Okay. I hope we were able to assist or answer your question a bit. It's tough to answer. It depends. It's like really, how it is. I wish you well. We all have, I'm sure some positions in our accounts that don't look so good right now. But,
it was sorry, apologies to interrupting, but it was all very helpful. And I think one of the takeaways is, I didn't have a return of less than 75% on this fund for years and years. Okay. I did very well with this fund. And so when there was a dip, I would say, I think it was March 2020, when there was that dip, I put in a few $100,000, and there was another dip. I was kicking myself because I did the same thing a few weeks before the skydive. And what I would say is, for me, another takeaway here is, I think I did my due diligence on the companies, and I'm happy with them, happy with all the companies in there. But I wasn't thinking of the macro. I wasn't looking at the geopolitical stuff, and I was looking at thinking about the fund, how it's done, how the sector has done, how this, that, and the other. And I was aware of the geopolitics, but I wasn't really thinking, considering it. And so I would just say to people, like, and it's a little disappointing because as a former history major, I would expect a bit more, but it's okay. We learn. But yeah, I'm holding. I'm not going to sell them, because at this point, it's exactly what you said, Rosanna. It's like, literally, like, why bother at this point? Like, I'll just wait it out. Thank you, everyone.
No, thank you, and thanks.
Thank you.
Thanks for reiterating that point that knowing the big picture where we are macro, it's kind of boring to talk about sometimes, but you have to know, just I keep it simple. If the Fed is raising rates, keeping things restrictive, or if they are cutting rates and providing liquidity and keeping things, accommodative. James, you had a question? You have your hand up. Thanks for waiting patiently. If you got a question.
Yeah, Joseph, I'm a big fanboy of you. Roseanne or Roxanne, is it?
Rosanna.
Rosanna.
That's good.
Hey, Rosanna. I'm really loving the space here today, and if it's therapy for traders or investors, what a beautiful time to get into this conversation. The great question is, one can never know, right? And that's the one thing about the market, is it's so dynamic. So if the market was always constant, all we would need is just pure mathematicians to always be able to do cost benefit analysis, and that would always be the benefit. But at the end of the day, it's not, because there's a lot of other internal issues that can change it. It's almost like it's a living, breathing thing that can really be affected by public sentiment. It can be affected by global events. It could be affected by geopolitical issues. It could be affected by government issues. And so I've only been playing the market for the last 6 years, and I have had a stretch of really good success, and I was starting to get kind of cocky and elements like that. But that's the great thing about any time, part of my existence has been a little bit of the Kenny Rogers song, The Gambler. You got to know when to hold them and know when to fold them. And there has been companies I was invested with, IPL, Inter Pipeline Limited, right? It paid an 8% dividend. It was a beautiful share. It had a constantness of basically riding right around $20 Canadian a share. There was some conversation that came into the marketplace about a Chinese company interested in purchasing them because they were working hard on developing a brand new um, location where they were going to make polymers and issues such as this. And all of a sudden, like with all of that heated excitement, the stock went up to $4, which is, at the time you're getting an 8% dividend plus a $4 capital appreciation per share. It was a great thing to be. So there you are, you're self training yourself on how to take profit at times. But all of a sudden, then came in, one of the big behemoths that is, very similar to like Greystone out in the States, in the Canadian landscape. And there was a hostile takeover bid, and then it became like dead money, and it tanked. My stock tanked. My 8% dividend went away, and all of a sudden there you are. You're treading water. You're treading water with, at the end of the day, and now you're going, okay, so what do I do here? What's my upside potential? What is the value of money? And if I take it out at this moment, where do I know where I could make this money, make my loss, or build something else, right? And so for me, my guidance came not from Warren Buffett, because I think he's hypocritical, right? Warren Buffett believes in owning companies that pay him a dividend, but yet Berkshire Hathaway never does. There's an irony to that, right? I think further to that, when I go and I play different marketplaces, not all things are equal. Right now, I'm heavily invested in natural gas. You see how cold it is out there, as was said on Twitter earlier today. Canada has declared war on the United States with this cold front. Like everybody's needing the energy cycle to sustain life, and so I think there's a real big value play on that. But in the last 2 years, part of the area where I made huge money was in potash. And it was something that I kind of paid attention to, had a little bit of insight, and took a chance because I had um, a macro view of how it could have some upside potential, and I benefited greatly. It was I bought it at 22 cents, and I sold it at $1.29. So those are the great things that you can have. But in that same time frame, I've also bought a stock that I paid, I think it was like $35, and now it's down at 17, right? And so I have had successes, but I've also had to wallow in. So this year alone, let's just recap mine quickly. In June 10th, I was at 79% market valuation. I was doing really well. Then, being as heavy as I was into the Canadian oil and gas side, it fell down. I'm still at 35% year to date. So nothing.
Yeah, energy's done well this year for sure. Yeah,
exactly, and that's
Yeah.
the thing. You have to be aware of what you're involved with, right? I think at this next year, having a defensive position on consumables and things that people can't really get away from, right? You need what you need, and that's the process. So, but these tech stocks, it's hard to say. I think there could be the appreciation for getting involved with Google. They have had a down hit, but like I said, I just like the conversation. We all go through ups and downs, but sometimes you have to have that talk to yourself and say, maybe it's time to go move on and find another horse to ride. So
thank you for thanks for sharing that with us. And you make a lot of great points about, the sectors there's always sector rotation. So if you look at the studies over time, certain sectors do well, and every dog has their day, so to speak. So sometimes energy does well, sometimes growth does well, sometimes value, different sectors. So it's important to recognize that. And I'm glad you've done well in some energy this year. And thank you for sharing that. I know Bar Charts had his hand up. Thank you for hanging out with us, one of our favorite people on here. So go ahead.
We love Bar Chart.
Yeah, Rosanna, you got me sticking around late tonight. So I just wanted to follow up on your discussion with Sphinx. And Joe, I didn't catch everything you said, so apologies if I'm repeating something. But
yeah, no worries at all.
Yeah, when an investor has a big loss, it's actually trying to come back from that is one of the biggest challenges that people can face, because we're emotional people. It's very difficult to recover from that, and we're always wondering, oh my gosh, is this going to be a new trend? Am I going to continue to make bad investments? Is there something in my analysis that's off? And I think, actually, assuming that somebody is allocating risk and capital appropriately across their portfolio, what you really should do is just put that one loss aside. As hard as that is to do, I'm not taking anything away. It's very difficult to put it aside, but the best way is just to forget about it and look for new opportunities. So if you're generally doing well, you're generally making the right choices, just continue to look for new opportunities. You're going to recover from that one loss. And I really think that's a better use of your energy and your mental state, rather than just continuing to focus on that one position that just, everybody has it. You're not original, you're not unique because you had a bad loss. We've all been there. So I just wanted to add that 2 cents.
I love that. That was excellent. Always excellent stuff from Bar Chart. Love the website, options and everything, and great people too. That was excellent. So important.
Before I forget, give Bar Chart a follow, and of course Rosanna for they're both awesome, and
Joe a follow too,
running these spaces.
Because Joe really needs followers.
I know, please. Yeah, I think I've blocked more people than I follow. But anyways,
I know. But awesome.
Please give them a follow.
Thank you so much. But awesome point. It's better to put your energy, your resources, your thinking, your mindset into something positive. Look for other opportunities. And reallocate properly accordingly. Thank you so much for that. Frank, I know my husband's here and he hasn't been on a space yet. He's a speaker, and I'm excited to have him speak. Can you unmute? You want to say something? Are you there? There he is.
Can you hear me?
Yes.
Yes. Okay.
Yes, we
Hi.
can.
We all hear you.
Thank you for having me on. I actually don't know how to raise my hand, so I apologize. But thank you for calling on me anyway. All right. Tom just said it and hit the just I guess hit it out of the park, or a bullseye, whatever you want to say. It's getting late over here on the East Coast. But yeah, we're all emotional. We're human and we're emotional. And these emotions that we have regarding stocks and trading are the same we have regarding relationships and with our children and work and everything else. And maybe sometimes we just think of it more as something more mysterious than everything else we're involved in. So, for example, I was listening to a space today that just came out on the Roe Show on cyberbullying, right? And it was cyberbullying, cyberstalking. It was actually with Dr. William Winter, who's actually in this space right now listening, not to embarrass him or anything. But, he's a superb psychiatrist. And, they were just trying to get to, but what causes a hater? What causes this animosity for no reason against people? And he basically was saying it's comparison. And, as Teddy Roosevelt said, comparison is the thief of joy. And so when we're doing these stocks, right? And in the Roe Show, what they discussed was, instead of comparing yourself to Brad Pitt or some supermodel and knocking yourself and getting all upset and jealous, why don't you compare yourself to Joe Schmo, or just someone a little easier that you could at least be, oh, I'm better, right? Or something, whatever it is. I don't want to be pejorative or derogatory regarding anything. But like, for example, even comparing yourself to yourself. Earlier, I think it was James was saying he had a stock that was doing great. And I know Sphinx was saying she was making 75% return year after year. At some point, it's like me comparing my six pack, which I, over 50, I still have one, but it's not the same as the one I had when I was 18, right? And my hair isn't as dark as it was, on my head when I was 18 as it is now. You're right. So like comparing yourself to anything, the stock, the year, everything changes. And, because 2020 was such a phenomenal year, which basically anything you did worked. I mean, at least that was my experience. It's even harder for people right now. So just comparing anything to what happened the year before, even in your own trading experience, or comparing it to other people's trades, because, most of the people who are, it's just a natural thing. You look at Facebook. Oh, wow, look, everybody's always on vacation. Wow, everyone's always smiling. Wow, everyone's so happy. But I'm not as happy all the time. I'm not always as happy. But if you look at that, you're going to think, wow, there's something wrong with me. And it's the same thing with the stocks, right? So now we go from personal things to the mysterious stock. Well, everyone posts all their gains, but, Sphinx was honest. James was honest. Rosanna, Joe, they all say it. It doesn't always work out that way, right? But you don't see that on the social media. So you start beating yourself up. You start thinking of fear of missing out. What can I do? Like you go on some crazy diet. It's the same thing. Oh, I'm going to go on this crazy investment thing. Like I can spend, I pay this person like $50 and they're going to tell me what to do. It's all the same thing. Just take the mystery out of stocks and apply it to everything else. Earlier today, when someone was talking about, just find that one stock in the sea of stocks, right? And it's like, all right, so it's sort of like dating, right? It takes a lot of work. You find a lot of rotten, there's a lot of fish in the sea, fine. There's a lot of rotten ones, for you, right? But you find that one fish and you live with that fish through good and bad, right? And it's like the stock. So, again, it's been a long night. You guys have gone over a lot of topics, and but I just think stop making the stock so mysterious. Just apply everything else you've been involved with, from relationships to family dynamics to health, and how everything is like every day is a daily. I'm not going to say struggle, but every day there's uncertainty with all aspects of life, and stocks aren't anything different. And and I think that's about it regarding that. Unless I don't know.
Hey, hey, Frank, nice speech, but you look better than Brad Pitt. I just want to say,
Oh no, I wasn't going to say it, but yeah, I know. If you like dark hair and dark eyes, yeah, I'm fine with that. So again, but if you like tall and light hair, then I lose, and that's fine. I can live with that. I'm happily married, so there's nothing with that. And again, actually speaking about it though, I put up a quote in the room because Joe and let's see, Joe Roe Show. That rhymes because we have the Roe Show, and now I'm looking at them too. You got the Roe Joe Show. Okay, I'm going on a tangent, but anyway, they were talking together about how don't listen to me, don't listen to them, don't listen to anybody, follow yourself. And I put a quote from Thales, because Socrates used to say that, knowing yourself is wisdom and everything. And so, but this guy said, no, the most difficult thing in life is to know yourself, and I think that's part of the problem too that happens with, as far as following other people, because we don't trust ourselves. We lack that foundation, right? And what happens with a home if the foundation's bad, right? Or what's going to happen? It's just going to collapse, right? So something has to fill that void. And what fills these voids, especially with social media, is other people's ideas of what success is, right? Other people's idea of what happiness is, other ideas of how often you're supposed to be happy. And, we fill this with these things, and people just live unexamined lives. And it's just, you see data, right? The CPI comes out. I know my wife, she's actually reading the damn numbers. And I'm like, that's really boring. But that's what you're going to have to do, sweetie, if you want to invest. You have to read the numbers yourself. You can't rely on some summary or from some prognosticator or somebody else going out there and doing it. And even when the labor statistics came out, when they had come out, I think it was sometime in June, we know from our business, firsthand, and again, it is anecdotal evidence, right? Because we didn't do something around the country or anything else, but we had a surge of job applicants out of nowhere. Like, it was ridiculous. Anything, whether it was manual labor, blue collar, whatever it was, anything we had available and stuff we didn't even have available, we had people asking. So when they reported that, there was, I think, over 1 million something jobs, this and that, I said, it's impossible. There's no way. There's too many people. Maybe all the jobs are in other states. But, people keep asking us for work. And, Rosanna then started looking at the numbers. She said, oh, there must be a lag, this and that. And now, Rosanna, right? Wasn't it pretty recent? Like just the past day or so, they just came out that, yeah, they had made a mistake, the Department of Labor.
Yeah, the Philly Fed. Yeah, they had a correction. There was like showing 1 million new jobs. It's actually 10,000. That was like a recent
that's a
thing.
huge mistake, right? But the point was, we relied on ourselves. We said, wait a second, this doesn't make sense. I know that's what they're saying. And again, it's only anecdotal, here in New York, but something's weird. You got to look into that. And she wrote a nice thing about it. I think sometime in whenever it was over the summer.
Yeah, I have to jump in. I want to add to that. It's avoiding groupthink and being an independent thinker. And that's really what it is. It's trusting yourself and being a thinker and actually thinking for yourself. And I think that's what a lot of people aren't doing as much of nowadays. They're following the group and they're just having a shortcut to thinking. They're not really thinking. And it's the filter bubbles, the echo chambers. And there was someone named Morrow on here who runs these great spaces. And he actually said that that is the biggest enemy of our times is filter bubbles. So it's all that. And it's just about, if anything we can do to help anyone tonight is just think for yourself. Just like think and don't follow the group and don't follow other people. And I know Joe touched upon this earlier, Sid, everyone mentioned this, but it's so true. Just trust yourself, know yourself, but do your own thinking, follow your own plan, your own strategy, what works for you. And that's most important, in my opinion.
Yeah,
and now
because
we
otherwise...
have Will's a speaker too, by the way.
Oh, no. Okay. All right. Well, he would be the best on this. Obviously he's the psychiatrist.
We have the psychiatrist here who just came up. Would you like to say something, Dr. Will?
Yes, I would. Yes, I would. I wanted to say I love you guys. Thanks for having me. And that's always nice to be recognized. And thank you. Thank you. So, okay.
We love you too. We love you, Dr. Will.
So, okay. Thank you. So, okay. So just a quick thought. First of all, I really enjoyed this. I was listening as I was playing chess. So I was getting like all types of stimulation. It was super fun tonight. So I had 2 games going on at the same time, the chess and like the thoughts about, and Ethereum was going up as we were talking. So that was nice. So, okay. So I have a couple of thoughts. when it comes to this kind of activity, the first thought is this idea of the future, because nobody could be right and nobody could be wrong, because nobody knows that other variable in the equation, which is the future. And so, so we take our best guess. And so it's kind of like, that idea of like you're driving in a car and the way you're doing it is not looking through the windshield. You're not looking forward. You're literally looking backwards in your side mirror. And based on your previous experience, you're assuming what the right, the correct direction is moving forward, which is ridiculous. But this is what we all do. And we all use our past experiences, I believe. And lots of times what we learned was not a good lesson for the next situation. It's like, for example, with Tesla, if you held Tesla over the years, you were rewarded for that faith in that relationship to that stock. And then now, I mean, it's fallen so much. So on the one hand, you say, I should, like, let's say somebody sold it on the way up and they say, I only made 10x and not like 20x. Next time around, I'm always going to hold Tesla. And now the thing's falling like a rock. I guess in the past, the difference was that Elon wasn't selling it. So that's a different, and there are other differences too. But I just wanted to talk about that one idea of like, sometimes we learn lessons. Sometimes they're useful and sometimes they're not. And that's what's so hard about this activity. And then the next thing I wanted to talk about is this idea of a community or like an organism. Like if we're all like one. And so, when a stock goes up, it's almost like the community is reflected in the price of the stock. And when the price goes up, the community has a higher self-esteem. You see, if you see it as one. And on the other hand, the community is based on some bigger parts and some smaller parts. And when a bigger part is selling, it's bringing down the entity. And so it's weakening it. And it's like killing itself off. It's like the hand cutting itself off of the body or something like that. I know it's an analogy. Take it for what it's worth. But the problem is that the problem I have with this, and maybe somebody could help me, is that it's kind of like a relationship between you and the stock, which is not really based on giving, it's based on taking. Because you put in the money, you're giving to take. Initially, you put in order to take back more later. So it's a taker relationship, actually. So this, unified community ultimately is like, can't wait to like kind of like, take their piece and run, because that's the game. That's the game. It's sort of like if you never sell it, then you ride these things all the way up and all the way down. And what's the point in that? Like somebody was saying earlier in the talk, there are very few Amazons and those kinds of things that can do so well for so long, and you're just rewarded to just hold forever. I mean, very few things like that. So it's a tough one. It's a real tough one. And then it reminds me, you're talking about follow the leader. It reminds me of like a wolf pack or a pack of dogs or anything like that, where you've got the alpha, and then basically everybody, the community kind of like attacks this one thing, and then people get to eat. And so like, I guess first in, first out. So the first in is the leader. He's first to the dance floor. He's like the alpha wolf, whatever it is. That's the one who gets to eat first. And then the other people get to eat afterwards. They get less. They don't get the prime, but they still get plenty to fill their stomachs. And I think that's kind of another way to, picture this idea. It's interesting. I like thinking about it in these different ways, because it is weird, because, when you're selling, you're almost like you're betraying the community when you sell out, but you're not, because you're there to make money. Everybody wants to make money, and there's no harm in that. and there's nothing wrong in that. That's the game, and we should all be happy for all of us when we make. So, anyways, and then the other thought about comparison, that's a different story, but that doesn't lead down any good road. If you make $1 or whatever in your involvement in your round trip, you buy, you sell, and you made $1, good. Somebody else made $2, okay, that's good for them. But at least you could all play again another time with another stock. Anyway, those are my thoughts. I just wanted to share. And well, thank you for that. Thank you so much.
Thank you. I love this. This is brilliant. What a wonderful addition to this space. This space it's like an entity. It has a life of its own. It started with macro, went to stocks, market psychology, and now we have the professional. Dr. Will is not only a close family friend he's known my husband since I think middle school, and he's like he's family to us. He's like my husband's brother, and but he's also a top child psychiatrist in New York City, and so we admire him so much for what he does. So thank you so much for your valuable input. Beautiful stories you gave us. That's how we learn. We learn through stories and through scenarios like that. So thank you. Sphinx, I see you had your hand up.
Oh, yes. Hi. It's not really relevant anymore, but I just wanted to say, sorry, it's my dog. I just wanted to say when James said that thing about Warren Buffett, saying that he would only consider investing in companies that pay dividends, but that his company doesn't. So one of the things that sort of helps me is to think strategically, is to understand the different positions that one individual is in when they make decisions, right? So what I would say to that, James, is it's actually very easy to understand, because as an investor, his goal is much different than what his goal is as head of the company, right? His own company. So as an investor, he doesn't want to invest perhaps in stocks that don't pay dividends, but would that be his concern as the head of the company for his investors to receive dividends? So to me, it's sort of like it's very easy to reconcile these kinds of things, because one individual plays many roles in life, right? The psychiatrist here, our psychiatrist friend, can tell us. And so once you recognize that, you can see, okay, he's wearing this hat now, he's wearing this hat now, and we all do it. And so it becomes very helpful to provide clarity. That's all I wanted to add. Thank you.
Thank you so much. Dr. Will, would you like to add anything?
Sorry, I turned off my mic for a sec. No, I think that makes sense. It's sort of like one person isn't one person. We're kind of infinite in who we are. It is interesting. I mean, it's always useful to keep that in mind. I just wanted to mention, like, we tend to idolize winners like Warren Buffett, Charlie Munger, and then we kind of, use what they say as if it's biblical in its importance and its truth. And some of the things that they say apply perfectly at certain times, and then sometimes they apply completely imperfectly. And I remember, I'll tell you a quick story, very quick. Charlie Munger, apparently, in 2014, Bitcoin basically went down from like $1,200 down to $200. And at 200, Charlie Munger called it rat poison or rat piss times 2, something like that. And I had gotten into Bitcoin around then. And I basically wrote it down from 800. I bought some at 800, bought some at 750, and wrote it down to 200. And my brother, who's a stock trader, tells me, sell it, sell it. And he's banging his hand on the table. I say, why? He says, because, Charlie Munger, that guy. I didn't know that guy at the time. Okay, who is he? Warren Buffett, he works with him. He's a big shot. He's smart. He's rich. He's experienced. He knows this stuff. He says it's rat poison ×2. Sell it. And I just said, Brad, it's $200. This is like, whatever. It's not even worth it to turn over this trade. It's like, whatever. I bought it. We'll see what happens. And then, I fell asleep. And then a few years later, I wake up and suddenly Bitcoin's alive. So, and the rest is history. So when Charlie Munger called it rat poison and told people to sell it at 200, if they did sell it, they were misled. So this goes back to this idea. Is he a prophet? Does he know the future? To predict the wheel is to invent the wheel. There's no way to know the future. We would have created it. So, a lot of these guys, pardon my French, are bullshit artists. I hate to say it. Yeah, he makes money, but, that doesn't mean that everything he says is gospel. And we have to keep that in mind with all of these people, all of them. And that's my thought. I'm never going to tell people buy this or sell this. Why? I mean, why? It doesn't make a difference in my life what they do. They do what they do. They'll make their decisions.
I think,
does that make sense?
yeah, perfectly makes sense. Doc, is very insightful what you just said, with a very concrete example, right? So we, I think Steve Jobs said in one of his speech, like him or not, that you kind of connect the dot backward, right? So a lot of the things become visible after the fact that what really happens, right? Charlie Munger making a comment at one point of time, he may be right at that time, but 5 years later, he may not be right? So perfect. I like it. Thank you.
And what Dr. Winter is also representing or illustrating here or demonstrating is that he has a solid foundation. And even though his brother was Series 7, 6, 63, then he got a 65, he has everything. He had his own hedge fund. This guy's telling, Dr. William Winter, sorry, I got to be more formal. He's telling, so you got the super trader, has his own hedge fund, basically telling Dr. William Winter, hey, you need to sell. And, Dr. Winter did his own formulation. $200, not even worth it. Not even worth turning the trade on this. And he kept it in. But, that's what I was talking about. Like, people don't have that foundation. They don't have they don't lead examined lives. They're looking for other people to tell them what to do. At some point, we're all adults. And, we need to take our own personal responsibility. So instead of saying, oh, this guy told me to do it or that person told me to do it, it's like, well, no, it takes you to basically agree to do it. And that goes with, anything on any level. Okay. You yourself have to agree to follow somebody else's recommendations. No one is exculpated from doing that. And, my wife and I have been, we're scammed out of money and stuff, just like probably most people do at some point in their lives if they've lived long enough and have invested and done certain projects and this and that, and while that happened, it was shame on us, right? So, taking accountability for it and everything. So I don't see Joe. So I see a hand up, and that's Sphinx.
Joe had to run. Joe had to,
okay.
he had to go. He had to wrap some Christmas gifts. He's a last minute person, I guess. But he was just like, I have to go wrap Christmas gifts. But anyway, Sphinx, did you have your hand up?
Yeah, I wanted to add to what Frank just said. Frank, you don't mind if I call you Mr. Rosanna, do you? She's just such a powerhouse. No, I'm just kidding. What I wanted to say to that is, this epidemic of what Frank just talked about runs rampant in the Web3 space, okay? And people just will do anything to displace responsibility for their actions. And there are a lot of NFT projects that turn out to be scams. And I don't like to sugarcoat things. I like to say things the way they are, because you know what? There are also some great ones. I like to associate with those. So I'm not afraid of pointing out, admitting that there are scams out there, but there are. But time and time again, people who have been scammed will come to spaces and say, this influencer said this. And it's like, okay, maybe a year ago, maybe, 6 months ago, but when it's like the 9th, 10th time we're coming and we're saying, when we say DYOR, okay, it's not just something we say to do your own research. That's just not some BS thing we say. It's not like just a saying. We say that, and I try to say this to people who want to get involved in the Web3 space, whether it's in crypto, whether it's in the NFTs, or start their own project. I say, this is the most important thing you can do is to learn how to do your own research, because everybody starts, right, from a different starting point. And everyone has a different ending point. Everyone has a different end goal. Therefore, your risk tolerance is different. So even if a certain person says, do this, this, and this, and they're completely genuine and well-meaning, it doesn't mean that you should do that. Okay? I've said this so many times. That's why the most important thing you can do is to learn how to do your own research. And it obviously applies to stocks as well. But it just runs so rampant in the Web3 space. And still we will do spaces that will fill up, and people will say, but should I buy? Should I buy? And they want others to make the decisions for them. And it gets to the point where, yeah, that's not the way to go. Like, you know what I mean? So I just wanted to comment on that and say that this sort of displacement of responsibilities, you can't rely on someone to take you to the moon, okay? And think that they won't also take you, 6 feet under. It's both can be possible. So if you want to displace responsibility, you have to realize one thing: you're giving up the reins. You're giving up the reins. Thanks for letting me talk.
I love that, because I always say the similar concept. You can't take criticism and not take praise, and vice versa. You can't accept praise but not accept criticism. They're both two sides of the same coin. So it's the same kind of thinking, like you just said. If someone's going to take you to the moon or take you to the grave, I guess is the scenario you said. So, it works both ways. And it's the same thing with risk adjusted returns. And I always go with cost benefit analysis, and I'm a very mathematical person. So I'm always looking at it from that perspective. And what does that take into account? You always need to know your risk. Now, it's the same thing with what you said, the positive and the negative. There's always, you got to see both sides. So when you enter a trade, we're not in 2020, okay? In 2020, it was only, how much can I make? It wasn't about how much I can lose. It was like, if I don't buy this, I'm going to lose because I didn't buy it. And that was like the whole thinking. So now it goes back to reality. And when you decide that you want to buy something, you need to first think, how much am I going to lose? What am I going to lose? This is my principle. See, I think people don't always associate it that way. Maybe it's because of the recent past of 2020, or maybe it's just something that it's something that needs to be learned. But you have to think, this is my principle, and what am I going to lose? And that's part of for assessing your risk adjusted returns, is knowing your risk first. So I like to use a Sharpe ratio. There's a few different formulas you can do. It's basically looking the return minus the risk-free rate divided by standard deviation. So you could do that mathematically, or you don't have to even go that route. You just have to just know ballpark at least, what am I going to lose on this? So it's very important to always think in those terms. And, it's to be accountable. It's not their fault. Who pushed the buy button? I did, not them. So I have to be accountable that it was my decision ultimately. And so it's very important you don't just blindly follow other people. And, you need to know that you're responsible. It's your money and you need to make the decision and stop blaming other people. I'm not saying any of you guys do, but I'm just saying in general, people I've seen in the FinTwit community, they like to blame other people and say, oh, they told me this or this or that. You're the one who bought the stock or the ETF or whatever it was, the option. You're the one that did. So you just need to be accountable. And there comes a time where you make mistakes. We all do. Professional traders do. We all do. And you just have to accept it and move on. And I love what Tom said. Stop putting mental energy into a loss. At some point, a loss is a loss. So just start looking for new opportunities. And also very important, because this has happened to me. Look, we all lose in life, okay? I'm a serial entrepreneur. I've started multiple businesses. I have run multiple businesses right now. I still run spaces. I just launched a podcast. I launched an investment educational site. I love doing things in multiples, I guess. I love just turning creative ideas into successful businesses. But there are mistakes that happen. There are plenty of losses, okay? And I'm the first to admit it. You're not alone here, and it's about self-aware, not being in denial, accepting your losses, accepting yourself. And, that's part of growth, because in order to grow, we have to know we made the mistake and have to accept it and learn from it. And they say those who don't know their history are condemned to repeat it. Well, it's true, because if you don't learn from it, you're very likely going to keep repeating it. And there are plenty of times many years ago, I didn't want to realize my losses when I did a trade or something. And I noticed I kept making the same mistakes. And until I finally just said, no, I was wrong and I made the mistake, I was able to finally make those positive changes and improve. So it hurts now, but it's okay. Take the pain now, accept it, and there'll be greater glory later on. It's just like delayed gratification. You delay that little immediate impulse to do something that feels good right now, but then there's greater glory later on. So it's all these human emotions. And I think trading, investing, businesses, entrepreneurship, all of this takes into account all these, we're all human. So it takes account all these different emotions, and it really heightens them, because you're at this stage of just like live or die. It's like your trade is like, it's pretty like core to the core. It's very primal. It's like you could lose your money, like you could lose a lot. And it's really, it's just, it brings out those feelings and those emotions. And like Frank said earlier, it's like a relationship. It's like a family member. It's like a child. It's your positions. You get very emotional about them, and, some people are better than others. Some people are able to detach and they can stay very stoic about it. And that's great. But, for many of us, it gets very challenging, especially during these times. I mean, this was a really bad market week. I mean, it was really rough, and a lot of people were hoping for some type of Santa rally. And the Santa rally actually takes place after Christmas into the new year, but it doesn't look good, and, it's just it's the holidays, and, we're hoping for better, and it will get better. And I can tell you that because I was in 2008, okay? It was bad. And you remember the whole GFC, the global financial crisis. It was really bad. I don't know, a lot of you maybe weren't around back then, but it was tough with our business too. And I have to tell you, and I don't want to go on too much, but these are the times when you grow. It's through the challenging times that you build character and that you grow. And I can tell you that from my experience. You know, I'm in my 40s, and I've lived, you know, quite a bit, and I've lived a lot of different lives. I'm very grateful for that. You know, I've been a commercial real estate broker. I had my own brokerage in downtown Seattle. You know, we did real estate investing. I had a women's only health club in South Florida. I started it, ran it myself with Frank. I could go on and on. A lot of businesses. I'm probably missing a few of them in between. But you know, we have a manufacturing business, international manufacturing, e-commerce now, and I've launched other businesses. It's fun. It's great. I love the challenge, and I love just growing with that. But you know, at the end of the day, you know, I have to say, it's just you just have to just accept yourself, and you just have to be aware of your own self, and you know, just be kind to yourself. And if it doesn't work out today, tomorrow's a new day, and there's always a new start, and there is light at the end of this tunnel. And you know, having been through 2008 and all the experiences, through the darkest times, the light emerges. So it may be a little longer than you thought. You know, maybe it's not next week, but it will get better. So, and I just want to say that just stay positive, and there will be brighter times ahead, and there will be massive opportunities. Look at history. It's always been that way. You can go look at the past, and you'll see it. After the darkest times, as far down as it goes, it's going to come up high. And, you know, it's just, I don't know when. None of us can predict when, but it will happen. So don't give up, you know, never give up. And just know that this may not be the time right now, but it will get better. So remaining liquid is very important. In my opinion, I always talk about cash, because I like to remain liquid for when these opportunities emerge. And there are plenty of opportunities upcoming at some point. So that's it. That's all I wanted to say. I'm sorry if I went on too long, but anyone else want to add anything to that? Oh, I see Frank has his hand up. Please speak.
Yes, yes, Master. Is it better that, again, this is my first time, well, second time speaking or whatever have you on a space. Do I respond to Sphinx's question first, or do I respond to yours?
Whatever you want. It's open, whatever you want.
Well, Sphinx made it very clear that, you know, you are, I would change my name, right? So I'm just asking. Super Rosanna, right? So I'm looking for direction. Tell me what to do.
Okay, you're very funny.
Okay, sorry. I see them smiling, so okay, it worked. As long as I laughed, that's really all that matters. Sorry. All right, anyway, but I'm glad they did too. All right, so we'll get to what you're saying. All right, first. So part of the thing is this, and Stephen Covey spoke about it. It's like we're building emotional bank accounts, right? Like with people. Like I do something nice for you, even if I don't ask or anything, no matter what, you get a little, it's almost like I'm putting a little chip in your account where it's like, oh, that was nice that you did that. And then I do it for someone else and someone else. And at some point, then those people may give a little chip back. You know, they may do something nice for me. Not that we're doing it to expecting reciprocity, but we're basically doing it to just be nice to people, right? So I think with the stocks, what Dr. Will was sort of saying is like, we put the money into the stock, and then the stock gives us something back. Maybe somehow they're connected. I don't know. But there is something to that emotional bank account when you're building relationships with people that works. And I wonder if somehow that's, again, because I was saying earlier, like, you know, stocks aren't, they're part of, we're all people, as Tom said. So we're emotional. So maybe that emotional bank account that Stephen Covey speaks about is applicable to stocks. So when a stock gives us some love back, as far as a percentage that goes up, maybe when the love that comes back and is reciprocated isn't 75% and now it's only 30, we're like, oh gosh, what's wrong? What happened? Versus just being happy getting even 5 or 10%. So I don't know. Regarding Sphinx, part of the thing you were talking about Web3 and any of the gurus and any of the influencers, as people call them, is this. You have to, in business, right? A really good book by Ringer called Winning Through Intimidation or Winning by Intimidation. I don't know, I read it in the 90s. But anyway, really good book, but he talks about the three types of people you meet in business, right? And the first type, and the one I respect the most, is the one who says, Frank, I'm going to compete against you and I plan to take all your chips. Okay? Because they're straightforward. Okay? So you have those people, out there, right? Who just say, look, I'm dishonest. I'm just bad. So, I'm going to try to screw you over however I can. Right? Then you got, but they're honest about that part. Then you got the second type of business person who says, oh, Sphinx, don't worry about me. You can trust me. I'm going to take care of you, but they're going to try to steal all your chips, So that's the second type of influencer that's out there. They know they don't have any good information and they're totally trying to screw you over, right? And, as you're saying on Web3 and everything. So those are two reasons, right? It makes sense. Okay, well, then I should make my own decision. But it's actually the third type of person in business in his example. And I guess in my opinion, in being in business, it's the third type of person in business. That's the one that really ends up hurting you. And that's the person who really loves Sphinx, really, really, really wants to help you do great. Their heart is into it. Their soul's into it. They're working day and night to make Sphinx do great. But guess what? They just can't help themselves. They screw up. They just make mistakes.
Fired.
And yeah, and that's what happens. So, but unfortunately, you've relied on them. You've given them all the money and everything else. And and yeah, they were great. They really meant it too, to help. But they just couldn't help themselves. They screwed up. And that's, and so there you have someone who has good intent, but yet you still get hurt. And so another reason why, through experience that, it's great that they're all heart and they all care, but they can screw you too. And again, I don't mean to be so vulgar or whatever the use of terms are here, but but anyway, it's a really good book with that. And, so that's why following influencers or anyone else, it really doesn't matter if the person's a good person. It really doesn't, because you need to figure out whether the advice is good for you on your own. And that's it. Thanks.
Thank you so much. It goes back to the concept of being a thinker. And I tweet a lot about this. If you guys follow me and know my tweets, I really try to combine a holistic approach to everything. Mindset is 70-80% of your decision making. My degree was in decision-making sciences. So it's a very core part of how I do things. And being an executive decision maker, that's what I do most days, like all day long. I have a great team of people, which I value. We base our leadership on the democratization of leadership. And so that's how we're able to do more. And I know Elon Musk does the same thing. He's a catalyst leader. Okay, and I tweet about catalyst leaders all the time. We, as you can tell from my husband, Frank, we're very well read. We're always reading, always trying to improve ourselves. And we want to share that knowledge with everyone, because it's all about us collectively elevating each other. Success is an abundance mindset. It's not a zero-sum game. It's not like I succeed, you lose, and vice versa. We're all here to help each other. And that's why we're here on Spaces. And I'm so grateful to have this platform that we can talk and share ideas with one another. And I learned so much from all of you. I'm so grateful for all of you. And
thank you for listening to the Rose Show podcast. Please visit RosannaPrestia.com for more episodes. See you soon.